what I like about REITs, what I like about dividends, is if you compare it to rental property, there's a lot of things that you need to consider in rentals. You still need to do customer service. You still need to check up on your unit. You have to deposit a check. If there's any errors in the check, or if it bounces, or if there's wrong spelling, you have to go back again. So it's not as passive. And you have to also deal with the headache with the tenant. The REITs and dividend stocks, they're just so convenient that you can enter them easily without taking a loan, that you don't need millions to be able to start it. But it's so easy also because you get yields, in my opinion, that are higher than some properties. Hey guys, so in the previous video we talked about REITs, and I mentioned that the lower it gets, it gives you the ability to be able to buy REITs at a lower price. And the amazing thing about REITs is that it's predictable. If you know that the company has tenants that are locked in for a long time and you know their occupancy rate, then you're quite good. And the more assets that they infuse into that REIT, the more revenue that they get. And since 90% of that revenue is given out in form of dividends to investors like you and me, it becomes a very, very good proposition because you get to buy it low and your dividend yield gets higher. In this video, I want to drill in and focus in even more into dividend stocks. If you've been following me for quite some time, dividend stocks are amazing because it gives you the ability to get cash flow. Dividend stocks are amazing because it gives you that level of predictability that when the markets are down, when there's a lot of fear, when there's a lot of uncertainty, when there's a lot of doubt, dividend stocks give you the ability to get cash flow. And I'll say this over and over, what's so amazing about cash flow is that you just have to build a base, you just have to accumulate, and you get regular amounts of cash coming your way without selling. Please do note that capital appreciation is amazing, buying low, selling high is amazing. However, the pitfall of that is what if the market is down? You would have to actually sell it to be able to appreciate your earnings. If the market is down, then maybe your earnings might be tapered. Maybe it might not be so good, or maybe you might just be close to break even, or maybe you might be even at a loss. If you're in it for dividends, if you're in it for cash flow, it doesn't matter if at that current moment the market is up. It doesn't matter if at that current moment that you need the money if the market is down. Because as long as you know specific months and periods where dividends are given, then you're supposed to be okay. If you look at it, even from Globe, that they give out dividends on a quarterly basis, then you can already anticipate this quarters I will have this much dividends already. You can already predict, you can already compute what you could actually get. Or in the same way, if you're looking at PLDT that gives out dividends twice a year, you can already project also how much you could actually get while this is all going on. So if you're in it for dividends, it doesn't matter if the market is bullish or bearish because you get your return. It doesn't matter if the market is down because you get your cash flow. However, in moments like this, when we are in an era where there's a lot of fear, uncertainty, and doubt in the global markets, in the crypto markets, even in our local markets, buying dividend stocks, especially the ones that are good, especially the ones that their revenue, the way they're run, the people inside are really, really good, and their market is still very, very big, and they have the ability to beat out the competition, then them dropping in prices gives you the ability to earn more. Them dropping in prices gives you the ability to have higher dividend yields. And if you look at it, a lot of the dividend stocks that have been very, very consistent in giving out their dividends, Meralco, I've been saying Meralco over and over because it's a utility. It's so predictable, but its dividend yield is relatively high. And if you've been analyzing the dividends that Meralco has been giving out, they have been very, very consistent, that they have been giving out their dividends on a regular basis. And that's what you look for when you want to buy stocks that are giving out dividends. Look at their business model. Is the competition big enough? Is the competition strong enough to be able to beat them? Or is the company good enough that no matter what happens, they will have revenue? And the answer to that is, if you analyze it, Meralco essentially is a monopoly. There will never be another distributor in Metro Manila that will compete against Meralco right here, right now, because there's a very, very large barrier to entry. You can already look at it from that perspective that, hey, since there's a very, very large barrier to entry, then the revenue that they're getting right now is somehow predictable. That the revenue that they're getting right now is somehow okay. I know that they will not run out of sales in the next year, in the next 2 years. And since they're earning money, since their consumers will actually pay because they need to pay their electricity, because if they don't pay their electricity, they will be cut off. And since they will be cut off, they'll be forced again to pay it back. They'll be forced again to have it reconnected, and they'll have to pay it again. There lies the unique sweet spot where Meralco is. It's a utility, their service is needed, they don't have competition, very, very large barrier to entry. They will have customers on a regular basis. Their customers will have to pay. They will not go bankrupt over the next 6 months, over and over and over. That you see it right now, that their model is predictable. And that being said, if you look at their history of the dividends that they have been giving out, they have been very, very consistent. So now, should prices drop, then you now have the ability to stock them. You now have the ability to buy lower. The key trick in all of this is that when you buy it, the dividend yield that you are getting should be already acceptable to you. If it drops and then you buy some more, then your dividend yield goes higher. It doesn't matter if the price doesn't go up over the next few months or over the next few years. As long as the dividend yield that you're getting is something that's acceptable to you, then you're supposed to be okay. But if it goes up in 5 years, if it goes up in 10 years, then you actually got rental income via the dividends that you have been getting. I didn't say this in the REIT video, no. What I like about REITs, what I like about dividends, is if you compare it to rental property, there's a lot of things that you need to consider in rentals. You still need to do customer service. You still need to check up on your unit. You have to deposit a check. If there's any errors in the check, or if it bounces, or if there's wrong spelling, you have to go back again. So it's not as passive. And you have to also deal with the headache with the tenant. The REITs and dividend stocks, they're just so convenient that you can enter them easily without taking a loan, that you don't need millions to be able to start it. But it's so easy also because you get yields, in my opinion, that are higher than some properties that when you buy them, you have to take out a loan. When you buy them, you have to do customer service. When you buy them, you have to go to a government institution every year to pay for real property taxes. There's a lot of hassles attached to it. But dividend stocks, ultra passive. They're volatile, but if you're not selling them in the next 8 minutes, if you're not selling them in the next 2 months, the volatility doesn't matter. What matters is the yield that you would actually get. Because if you look at it that way, that investing in dividend stocks, investing in REITs, is a alternative to rental income, dips like this shouldn't scare you. Why? Because when you buy a condo, you don't really check what the condo prices are in the next 2 months, because it doesn't matter to you. As long as you have a tenant and then they're paying your rent, and then you know over the long term what you bought is in a place that increases in value, it's situated in the middle, it's an area with high demand, then there's a possibility that over the long term that the price of that asset that you bought would go up. That should be your mentality also with stocks. Find a stock, find a company that, because it's run well, it's so good, it has great brand, it's maybe a monopoly, they have customers that will buy them every single time, that they have the ability to earn more and give you dividends on a regular basis. But at the time that you look at it, at some point in the future, the stock price is higher, and you also get capital appreciation, and maybe it comes to a point where you need to liquidate. When you sell it, you get to sell it also at a higher price, but you also get to do it in a way that's less hassle, less paperwork, very, very liquid, very, very fast. And this is something that is very, very helpful for people who are starting out, who don't have a lot of capital yet, that you now have the ability to get an asset that you can easily liquidate and get cash flow on a regular basis. And no matter if the market is down, you get to have the ability to have predictable returns. And I highly suggest that while the market is down, while there's a lot of fear, while risks are relatively higher, this is your shot, this is your chance to be able to look for great companies at cheaper prices. This is your chance to look at companies that are relatively cheaper than where it was in 2021 and get to have higher dividend yields. But please look at great companies. Please look at companies that are growing. Please look at companies that are really, really run well. If the dividend yields are attractive for you, go for it. Or you can look at other valuation ratios like PE ratios, PB ratios to check if it's actually cheap for you. I'm a big fan of dividend investing, and drops like this should not be something that should cause you to be fearful, but it should be something that should cause you to execute properly based on the amount of knowledge that you have, based on the amount of research that you've put in on the companies that you know. Please don't just buy a company just because it has dividends. Buy the ones that you understand the most, buy the ones that you have researched the most, buy the ones that make sense to your buy parameters. If you want to know more about dividend investing and REITs, We have hundreds of videos down below. We also have a webinar and a course that you can actually watch from the comforts of your home. I've also written 5 books that are available in Shopee and Lazada. Links are down below if you want to grab a copy as well. It's delivered to wherever you are in the country. If you like more videos like this, like, share, subscribe, and smash the bell so you get updated every time I come up with new content about investing. If you have any questions, put it down below. I want to answer them. I want to make videos based on the questions that you guys sent out. I guess that's it for now. I hope you like this, talking about stocks. Also, marvingermo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, and God bless you all.